There is a common tendency to evaluate the cost of a home based on its listing price, to look at a number like $500,000 and treat it as a fixed, singular expense, but in reality, the price of the house is only the surface layer of a much larger financial structure, one that extends across time and is shaped by interest rates, cash flow constraints, and the interaction between income and long-term obligations. What makes this particularly important in 2026 is that the conditions surrounding that price have shifted, not necessarily in ways that are immediately visible, but in ways that significantly alter the underlying math. Because the cost of borrowing, which operates quietly in the background, has become a dominant factor in determining the true financial weight of a home purchase. When a buyer approaches a $500,000 property, the assumption is often that the primary challenge is saving for the down payment, but once that barrier is crossed, the system begins to reveal its deeper layers, starting with how the purchase is financed. At current interest rates, even small differences in percentage can translate into large differences in total cost over time, and because mortgages are structured over decades, the compounding effect of interest becomes the central mechanism through which the real cost expands beyond the original price. If we take a simplified example, where a buyer puts down 20% and finances the remaining balance, the monthly payment is not simply a reflection of the remaining principal, but a combination of principal and interest that evolves over time, with a significant portion of early payments going toward interest rather than reducing the loan itself. This creates a dynamic where, in the initial years, progress toward ownership is slower than it appears, because while payments are being made consistently, the underlying balance does not decrease as quickly as one might expect. And this is only one component of the system. In addition to the mortgage, there are property taxes, which vary by location but represent an ongoing obligation that increases the effective monthly cost, and there is also insurance, maintenance, and potential repair expenses, all of which introduce variability into what might initially seem like a fixed payment. When these elements are combined, the monthly cost of owning a $500,000 home can extend well beyond the base mortgage payment, creating a total financial commitment that must be supported consistently over time. Another layer that often remains understated is the opportunity cost of capital. The funds used for a down payment, closing costs, and ongoing expenses could have been allocated elsewhere, potentially generating returns or providing liquidity, and when those funds are tied into a single asset, they become less flexible, which can influence how other financial decisions are made. This does not mean that homeownership is inherently disadvantageous, but rather that it involves trade-offs that are not always immediately visible. There is also the interaction between housing costs and income stability. A mortgage represents a fixed obligation, one that does not adjust downward if income fluctuates, and in environments where income is variable or uncertain, this can introduce a layer of risk that extends beyond the simple calculation of affordability at the moment of purchase. This is where the concept of financial resilience becomes relevant, because the ability to sustain payments over time depends not only on current income, but on the stability and predictability of that income. In addition, the structure of the mortgage itself creates a long-term commitment that interacts with inflation in complex ways. On one hand, inflation can reduce the real value of fixed payments over time, making them more manageable in later years, but on the other hand, it can also increase the cost of maintenance, taxes, and other associated expenses, offsetting some of that benefit. This creates a system where different forces operate simultaneously, some reducing the burden and others increasing it, and the net effect depends on how these variables evolve over time. Another important consideration is how housing fits into the broader financial system of an individual. A home is both an asset and a liability, depending on how it is viewed, because while it may appreciate in value, it also requires continuous outflows of cash to maintain, and the balance between these two aspects is influenced by market conditions, personal circumstances, and time horizon. In periods where property values increase, the asset side becomes more prominent, but in periods of stagnation or decline, the ongoing costs remain, which can shift the overall impact on financial position. There is also a behavioral component that can influence outcomes. Owning a home can change spending patterns, risk tolerance, and financial priorities, sometimes leading to increased stability, but in other cases creating constraints that limit flexibility. These behavioral shifts are not always accounted for in initial calculations, but they can have long-term effects on how the financial system evolves. When all of these elements are considered together, what becomes clear is that the true cost of a $500,000 home is not a single number, but a range of outcomes shaped by multiple interacting variables. The listing price is simply the entry point into a system that unfolds over decades, influenced by interest, expenses, income, and external conditions. And within that system, small changes in assumptions can lead to significantly different results. From a broader perspective, this reflects a more general principle within financial systems, which is that visible costs are often only a fraction of the total structure. The majority of the impact comes from the way those costs interact with time and behavior, gradually shaping outcomes in ways that are not immediately apparent. And this is why understanding the full structure is essential, because decisions made based solely on surface-level numbers may not fully account for the underlying dynamics. Ultimately, the question is not simply whether a $500,000 home can be purchased, but how that purchase integrates into the larger financial system, how it affects flexibility, stability, and long-term positioning. Because in systems governed by time and compounding, the initial price is only the beginning. The real cost is determined by everything that follows. And when this analysis is extended further, another layer begins to emerge, one that is less about the visible structure of payments and more about how those payments interact with time, uncertainty, and system constraints over decades. Because a home purchase is not a static decision, it is an entry point into a long-duration financial commitment that evolves alongside changing conditions. One of the more subtle dynamics is how front-loaded the cost structure actually is. In the early years of a mortgage, a disproportionate share of each payment is allocated toward interest rather than principal, which means that while cash is consistently leaving the system, equity is not accumulating at the same rate. This creates a period where the financial burden is high, but the visible progress in ownership is relatively slow, and if the homeowner needs to exit the system during this phase, the financial outcome may not align with initial expectations. This front-loading effect is often underestimated, but it plays a significant role in determining how flexible the decision is in practice. Another layer involves the interaction between housing costs and life variability. Over a 20 to 30-year period, it is unlikely that income, expenses, or personal circumstances will remain constant, and because the mortgage obligation is fixed, it does not adjust to these changes. This creates a form of rigidity within the financial system, where one component remains stable while others fluctuate, and managing that imbalance becomes part of the long-term challenge. In stable conditions, this rigidity may not be noticeable, but in periods of disruption, it can become more pronounced. There is also the question of timing within the broader market cycle. Housing decisions are often made based on current conditions, but the outcomes are influenced by conditions over many years, including interest rate environments, local market dynamics, and broader economic trends. Because these factors are not predictable with precision, the decision inherently includes an element of uncertainty, and the impact of that uncertainty is distributed across the entire duration of ownership. This means that the true cost is not only a function of the initial terms, but also of how external conditions evolve over time. Another important dimension is the concentration of capital. When a large portion of financial resources is allocated toward a single asset, it changes the overall structure of the system. Diversification decreases, liquidity is reduced, and the ability to respond to new opportunities or challenges becomes more limited. This concentration can be beneficial in certain market conditions, particularly if the asset appreciates, but it also introduces a level of dependency on a single variable, which can increase systemic risk. In addition, there is the ongoing cost of maintaining the asset, which extends beyond routine expenses. Homes require periodic upgrades, repairs, and adjustments, and these costs are not always evenly distributed over time. They can appear in clusters, creating periods where financial outflows increase unexpectedly. This variability adds another layer to the cost structure, one that is difficult to model precisely, but significant in its cumulative effect. There is also a temporal trade-off that becomes more apparent over longer horizons, which is the balance between present consumption and future positioning. Allocating a substantial portion of income toward housing can limit the ability to invest in other areas during key compounding years, and because early investment periods tend to have a disproportionate impact on long-term outcomes, this trade-off can influence the trajectory of the broader financial system. This does not imply that one choice is inherently better, but rather that each choice shapes the system in different ways. Another layer to consider is the psychological framing of ownership. A home is often perceived as a stable, long-term asset, which can create a sense of security, but that perception can sometimes mask the ongoing financial commitments required to sustain it. This can influence decision-making, leading to a focus on maintaining the asset even when conditions change, rather than reevaluating its role within the overall system. Over time, this behavioral tendency can reinforce the rigidity of the structure. There is also the interaction between fixed costs and inflation. While inflation can reduce the real burden of a fixed mortgage payment, it simultaneously increases the cost of other components, such as maintenance, insurance, and taxes, which are not fixed in the same way. This creates a mixed effect, where some aspects of the system become easier to manage while others become more expensive, and the overall outcome depends on the relative magnitude of these changes. From a systems perspective, what becomes clear is that the cost of a home is not a linear function. It is dynamic, influenced by multiple variables that interact over time in ways that are not always intuitive. The initial price sets the structure, but the evolution of that structure determines the final outcome. And because many of these variables are uncertain, the range of possible outcomes can be quite broad. There is also a long-term feedback loop between housing decisions and financial behavior. Once a significant portion of income is committed to housing, other decisions begin to adjust around that constraint. Spending patterns shift, risk tolerance may decrease, and financial priorities can become more conservative. These behavioral adjustments are not inherently negative, but they do shape the trajectory of the system in ways that extend beyond the initial purchase. As the system continues to evolve, another transition begins to take place, which is the shift from acquisition to maintenance. In the early phase, the focus is on securing the asset. In later phases, the focus shifts toward sustaining it, managing costs, and integrating it into a broader financial structure. This transition reflects the long-term nature of the commitment and highlights the importance of viewing the decision not as a single event, but as an ongoing process. And when all of these layers are considered together, the hidden cost of a $500,000 home becomes less about any single factor and more about the interaction between them. Interest rates, income stability, maintenance variability, opportunity cost, behavioral changes, and time all combine to form a system that is more complex than it initially appears. The listing price is simply the visible entry point. The true cost is embedded in how that entry point interacts with everything that follows. Ultimately, this leads to a broader understanding that affordability is not just about qualifying for a mortgage or meeting a monthly payment. It is about how that payment integrates into a dynamic system over time, how it influences flexibility, and how it aligns with both current conditions and future uncertainty. Because in long-duration financial decisions, the most significant outcomes are not determined at the moment of purchase, but through the continuous interaction between structure, behavior, and time. And there is one final layer that brings this entire structure into clearer focus, which is the role of adaptability within a long-term commitment. Because over the lifespan of a mortgage, the ability to adjust becomes just as important as the ability to sustain. Financial systems do not remain static, and decisions that appear manageable under one set of conditions may require adjustment under another, which means that the strength of a housing decision is not only measured by its initial affordability, but by how well it allows for change over time. A fixed mortgage, by its nature, limits certain forms of adaptability. The payment remains constant, the obligation persists, and the flexibility to reallocate resources becomes more constrained. This does not make the structure inherently problematic, but it does mean that other parts of the system must absorb the variability. Income must adjust. Spending must shift. Saving strategies must adapt around the fixed core. And over time, this creates a system where flexibility is redistributed rather than eliminated. There is also a pacing element that emerges from this structure. Because housing represents a long-term commitment, it effectively sets the tempo for other financial decisions. It determines how quickly capital can be deployed elsewhere, how aggressively investments can be pursued, and how much margin exists for unexpected changes. In this sense, the decision does not just affect one area of finance, it influences the rhythm of the entire system. And when that rhythm is aligned with income stability and long-term objectives, the system can function smoothly. But when there is misalignment, even small imbalances can compound over time. Another subtle but important aspect is how expectations evolve. At the point of purchase, the focus is often on what is affordable in the present. But as time progresses, the definition of affordability can shift, influenced by changes in income, priorities, and external conditions. What once felt manageable may feel restrictive, or conversely, what felt like a stretch may become more comfortable. This shifting perception highlights the importance of building a system that can accommodate change, rather than one that is optimized only for a specific moment. And this brings the discussion back to a central idea. The hidden cost of a $500,000 home is not just financial. It is structural. It is embedded in how the decision shapes flexibility, influences behavior, and interacts with uncertainty over time. The numbers define the framework, but the experience is determined by how that framework adapts as conditions evolve. Because in long-term financial systems, resilience is not created by eliminating uncertainty, but by designing structures that can continue to function within it. And within that perspective, the true cost is not just what is paid each month, but how that payment shapes the system around it, quietly influencing decisions, opportunities, and outcomes across years that extend far beyond the initial purchase.